All right, we are recording. I am with Kevin Jefferson, and I had Kevin on my podcast a few weeks back, and he's into trading. Now, you guys know in the Tykr community, we're big into investing. So why in the world would I bring a trader on? Well, a lot of traders, as we teach in our community, they do lose money. It can be high risk, but there have been a few people like yourself, Kevin, that have come on and talked about a logical approach. It does take a lot of work and a lot of training, but I wanted to give them a little sneak peek at what you do. And before we even get into that, I'll have you tell people about your backstory, kind of how you led to what you're working on today. You've got a business that kind of teaches people how to trade, but you do a lot, like a lot of podcast appearances, and you do webinars teaching people for free, which is really cool. So thank you so much for joining me. I know my community here is excited to learn how in the world do you use charts to make money? So we're going to start to answer that question today. Before we get into it, I'd love to start seeing where people are from. If you would go ahead to the chat window and mention where you're from. Real quick here, if you guys don't already know, I'm in the Milwaukee area, and Kevin, you're in the Dallas area. Yeah, nice. We got Tim. Hey,
Phoenix.
Tim from
Okay.
Phoenix.
Mexico, Monterrey. That's
Monterey. Nice. Boise. Cincinnati.
DFW. Okay. Now
Cool.
two for our hood.
Really? Another one
In
from
Houston, Texas
Houston.
representing.
Nice.
Okay. Love
Yeah.
it. Leo. Gentry Elementary. So you watching this on break or something? Or are the kids in class?
Leo's a usual suspect. He's been on here a lot. We're good buddies. Um, Mukesh, I see in the Q&A. Yep. From London. Awesome. Tanya, you're from London. Nice.
Okay.
Football intros.
Okay. That's funny. I'm glad. Okay, cool. All right,
Kevin
we are
Kevin
vibing
played,
then.
so
Right,
he
exactly.
gets
Okay,
the
we're good.
joke.
That's pretty good. That's pretty
Yeah.
good.
We're joking about that yesterday, a little prep call. Like if somebody like says they know how to trade, but they've been doing it for 2 years, it's kind of like that person that said, I played football and played for the NFL. And Kevin's response was, no, you didn't.
Yeah.
No,
And just because you were on the high school team, even because you were varsity, does not mean you were in the NFL. Like that's
no,
not the same.
no, no,
Yeah.
absolutely. Yeah. Cool. All right. Awesome, guys. Well, thank you for joining. With that being said, why don't you take a few minutes here, Kevin, give us your background, and then we'll dive right into, you're going to be sharing your screen and showing us a few examples of some stocks and even potentially crypto. But anyway, I'll
Yeah.
let you take it
Well,
away.
Sean, thank you again for the vehicle and the platform to share with other people my journey over the last, basically 15 of the last 21 years that I've been in finance. A little bit about me for those who have not, checked me out. I'm just a regular public school product. Even went to public school in college, even though I did graduate from the military academy at West Point, and that's something of which I am proud. So, go Army, beat Navy. But I was an Army officer, and remember being I was very intentional about that. I didn't see myself being a career military officer, and just where I was at the time mentally. And so I was always in the mindset because although I minored in IT, my major was English. And so I was thinking I had to go be either professor or a lawyer, because like, how am I going to make money as an English major, right? Literature and philosophy specifically. And so finance was always near and dear to my heart. And so I just kind of kept that in the back of my mind. I started getting into investing right after I graduated, good old dollar cost averaging into some mutual funds, Franklin Templeton and, Ariel and different, companies out there. And it just really was intentional about kicking off my life, in the right way. And some would say I'm late, but, that wasn't the topic of conversation. Entrepreneurship was the topic of conversation in my world, but investing as a passive or semi-passive investor was not. And so as soon as I got on that train, I started investing. And at a certain point, when I got out of the military, I was working for a manufacturing company. I was actually specifically Georgia Pacific. So if anybody's out of Atlanta, the headquarters over there, I used to frequent all the time. I think his name was Pete something, Pete Carell. I can't remember his name. He's long gone. And so I was in a little fast track management program, but I still was studying the markets. And so, everybody who remembers back in 1999, you could basically look at a screen and make money in the market. And so that set a lot of people up for failure. I remember, seeing Enron at the top of the list for energy companies and their numbers being so outrageously outpacing everybody else's that I definitely wanted to be a part of it, just like
Mhm.
everybody else. But thankfully, I didn't have that kind of cash, and I didn't, and I was probably too lazy to take action, so that probably saved me some money. But I was just a regular dude who wanted to, wanted to have more, and knew that I wanted to be rich, honestly. And so when I was with Georgia Pacific, I started studying. I'm sorry, when I was with Georgia Pacific and I graduated from their fast track management program, I had to move because I literally trained for a year. So I was in Memphis, Tennessee, trained for a year with the company, and then you have to transfer so that you can lead, the troops, so if you will. And so I moved to Huntsville, Alabama, and on weekends and whenever I could, I literally would just go to Barnes and Noble and study, what it takes to become a financial advisor, ADV forms, fee only planning, all that stuff. And one day while I was working with GP, a headhunter called me looking for ex-military officers and NCOs who may have been interested in financial services. And it was 2 months after September 11th, 2001. So it was November of 2001. I got a phone call and to fly up to Princeton, New Jersey to interview with Merrill Lynch. And so I went down that rabbit hole and got into the business at a very curious time. And I think that truly, how you see things can make everything into a blessing for you. And so, although on its face, the timing of me getting connected with a wirehouse and becoming a stockbroker didn't seem to make sense for me. All I wanted was an opportunity. And so I always tell people, when you're prepared, there's never really a bad time. And so that's what I take with my trading. I tell my students the same thing. Preparation is really the biggest thing that you can do to set yourself up for success. And so, I know we get into that a little bit later, but so I took that, took that bet, and I survived, got recruited away, and then I eventually started my own firm in 2005. And life happened. I went through a divorce. I moved back to Texas. Basically started over. I remember, was it like 2008? I think when I moved back, 2009, 2000, somewhere around there. I remember the word of the year was humility. That's what
Mhm.
I could say. Like it was just I was humbled on so many levels in my life. But I found trading when I moved back, just kind of stumbled upon it and got involved, started learning about it. And it wasn't very popular, like you say, 15 years ago, it wasn't as popular here as it has been globally. And I just kind of rode that wave, did a lot of the same things that most traders do, whether you're trading futures, Forex, equities, we're all humans. And the biggest battle that we're fighting outside of the knowledge of how to trade the markets is the battle between our ears, our psychological battle. And it's not just mental, about, just your mental ability to grasp concepts. It's really about all of the things that are laying under the surface that you don't know are there, that come out at the worst possible time. Like, the worst, the most fundamental aspects of our humanity and our cavemanity, all of those
Mhm.
habits, the fight or flight, all that, the issues that we have with money and what we've been told about money being what it is, and what the love of money is. And so all of these things we've accumulated in our lives. And that's why I started teaching my sons pretty early. They'll come in, and I love when one of my sons they'll come to me and they say, Dad, I saw something today in class, and it was like an uptrend and a downtrend. It was like this, and it was a chart that had nothing to do with trading, but they just got the concept. And so I think the earlier that you learn certain things, the less blockages that you have, and so the more
Yeah.
successful you can be. And so I had a lot of mental things to overcome. I was greedy. I was not patient. I realized that I lacked patience. And then I also realized that I may have had some blocks as it relates to making a certain amount of money, because I've seen it so many times. Once you get to a certain level of success, and it may not just be trading, but people will hit a certain mark, and they make X amount of dollars as a trader, and then curiously you'll see them fall off the cliff. And I think that's purely a matter of their psychological makeup and how they approach it and what they believe that they deserve. If you can make $100,000, $200,000 in 2 months, which we did in our 60-day challenge that we did in December, where I traded for 60 days to show people the potential power of trading. And we between my two accounts accumulated a little bit over 100, I don't know, close to 200 grand, I guess we made. And so when you can do that and you can make somebody's salary in, a matter of months, and and I'm not saying that to enforce, like, I don't want people going down that path. I think getting rich slow is getting rich fast, right? So you got to really just take the process, but just the idea of that you can do that, some people can't even get that in their heads, right? I mean, so if you have those blockages, those are things that you have to overcome. And so it doesn't matter what system you have, it doesn't matter who's teaching you, it doesn't matter, whatever it is. If you can't get past yourself, you're only going to limit your success. And so trading for me, how I kind of stumbled upon it and got into it. In the first few years, I stumbled, I lost, I told you in the last podcast, one week I lost 30 grand. I mean, basically what 60% of my account I lost in a week. And and all those things that people don't talk about on the internet, those silent nights and those dark times, that's what makes you the overnight success. So I say, if you call me an overnight success, I'll agree to that, as long as you call it on the back end of the longest night of my life, because that's exactly what trading was. I mean, it's like, you go through this valley of the shadow of trading death, and you don't know if you're going to make it out, but you just keep walking forward, and eventually you see daylight. And so I just, I love it. I replaced my advisory practice income, and I was able to keep some clients that I liked, and then not have to recruit for more clients, because I really realized that I don't know how much I like people. Maybe I like people less than I thought I did, but maybe I like my time freedom more, because I had a lot of great clients. But when somebody calls you and you're on vacation, you kind of feel like you got to answer, because you got their money, at your disposal.
Mm-hmm.
So I just wanted more freedom, and I'm grateful. I was able to trade when I wasn't married. I didn't have any children, and so I really locked in that, that 1 to 3 year period where I was really getting better at it. I put a lot of time in it, and I want people to know that it's no different than anything else. If you're going to a university, a trade school, 2 year college, if you're going to get a certificate, you have to put in the work. You have to put in the time, and nothing comes overnight. And I was actually, one of my clients I was on the phone with, he's in real estate. We were talking about some stuff that he had going on, and somehow we got into the idea of people wanting to kind of rush to the win. And the thing is, we were talking about children. That's what it was. We were talking about he has a podcast, and he was saying we're making adjustments, and we're trying to make sure that we're, he and the co-hosts were present fathers. And we laughed because he's a super present father. But I told him, I said, success in certain areas of life specifically is truly a horizon. It is not a destination, right? And so I think being a great parent, or being a present parent, is a never ending journey. So like you never get
Mm-hmm.
there. And it's the same thing as being a trader. You never ever get there. And the day that you feel like you've got it all figured out will be the day that you fall off the cliff. And so it's really a great tool to keep you humble. Honestly, more than the income that you can make. I think it's the best mirror that I walk around holding up to myself, because as self-aware as you become, like, you see the whole world differently, and it just forces you to be kind of a better human. Organization, mentality. You test hypotheses. You look at things differently. You look at so many things as almost like a sports bettor. You're looking at things in terms of
Mm-hmm.
probabilities. And all of that stuff is kind of unwinding the mindset that most of us have. As individuals, which is, we feel like we always have to be correct. And so when you feel like you have to be correct, that puts you in a really dangerous place as a trader, because now you haven't given yourself room to lose. And you haven't given yourself room to grow and learn, because you're saying that you have it all figured out. And I had a mentee, he's in Houston actually. He's learning to trade. He just started trading a few months ago. And so we had a phone call back in November, I remember, and he was telling me about what size risk per trade he was going to take. And he was like, yeah, all I got to do is X, Y, Z, and then I'll get this much, and I'll be good, and I'll pass the challenge. And I was like, man, that sounds like a lot of risk. And he's like, yeah, no, I mean, but this method that I'm learning is really good. He wasn't learning my method. I was just mentoring him on actually
Mm-hmm.
somebody else's method. So that's that. We'll get into the three things here in a minute. But
Yeah.
um, he came back, because I was watching his work. He blew he was a prop firm account, so he was trying to pass a challenge. And so anyway, what a prop firm is, for those who don't know, or funding company, there are companies out here who, in the equities market, futures, forex, they will allow you to trade their capital in exchange for a percentage of the profits that you make. But before you get to that point, in most cases, you have to pass some type of basically you have to pass a test, and you have to pass it within the risk parameters that they set for you. And that's their way of identifying whether or not you're actually the kind of trader that they want. And so my student was going through this process, and he blew his account the first time on an errant entry. Like, his lot size, he didn't know it was too big. And then the second time, like, I guess he got on the wrong side of the method, And so he had a succession of losing trades, and it knocked him out. And so he said, well, I'm gonna take a timeout. I'm gonna step back. And so we talked last week and or at the beginning of this week, and he was like, man, I was taking way too much risk. And I was like, that is so funny because we talked about this 2 months ago, but like some things you just have to go through yourself, right? Like somebody can tell you anything about something being hot or being cold or being slick or being wet or dry, whatever, but something in human nature feels like you got it all figured out until you get slapped across the face. And so you have to be open to those slaps because he's more humble now than he was 2 months ago
Yeah.
because he had to learn that lesson. And that's what I like about trading. Like nothing touches you aside from maybe family and outcomes with your kids and people you love more quickly than when you lose money. I think just in general, like people really have an emotional reaction to that. And so if you allow that to be your scorecard, not from a standpoint of being a bragging, but from the standpoint of saying, okay, as a trader, my account, in many cases, you don't control anything, but my account is a reflection of how I see things, and it's a reflection of me. And so if we could all live life and literally make or lose dollars based on dumbass decisions that we made, like we would all be much better. I think a lot of us would be better people, because you're either a great person and you're evolving and you're becoming wealthier or you're devolving and you're becoming broker, or if that's a
Right.
word, but yeah, man. So anyway, I love trading. I've enjoyed it, the last 15 years of the 21 years I've been involved in it. And it's grown me as a person. And so I just decided to put a dress on it, put some lipstick on it, put some glasses on it, and have fun with it, because
Sure.
it gets boring. And so that's the way keep it teaching people and helping people learn and make money through this is the way that I keep it interesting for myself. So
Right on.
anyway.
We'll get to the screen sharing and some of the tactical methods here in a second. Few key takeaways if you guys heard some of the details here. You can lose a lot. As Kevin shared, he lost 30 grand, and this is not unrealized losses. This is realized losses. The difference is, as investors, we can have unrealized losses every day, and that's when you see your account go down or a stock go down, but you don't sell. So in my case, like I really don't care. Like if the market goes down, I'm usually buying more. But if it does and I see my stocks in the red, no big deal. Unrealized losses, I'm not selling. I'm not going to make them realized losses. So I sell for the loss. With trading, Kevin, as he mentioned, he lost over 30 grand in a week. Realized losses, painful. This
Yeah,
happens. So
chest, guts, like yeah, I mean,
yeah.
drinking, all kinds of stuff. Like I, there's some things that you just don't forget. I mean, like I just remember like that day. That day was that day is burned into my mind, like just
Hmm.
burned into my mind. So, yeah, and I don't.
Yes.
Yeah, that's all you need. You need one of those to get you right. Hopefully, just one.
Right on. Remain humble. That was another key takeaway here with his intro is remain as soon as you get a little cocky, right? Oh, I can do this. Well, that's when you get bit. So I really like that takeaway. So, and then the last point would be mindset. With investors, we need to have the right mindset. Especially when the market's going down. 2022 was a recession, part of 23. People would freak out and sit on the sidelines, or you could take action, put that capital work, and watch your account really take off thereafter. And that's what I hope a lot of you did in 2022 and 3. But with trading, the way you have to manage your mindset, it's another level up. It can be like if you can't do it with investing, you probably won't be able to do it with trading. So we want to kind of look under the hood, if you will, a little bit here to see how Kevin thinks about trading. So with that being said, why don't you, where do you want to start? I know we want to talk about three key things, and then we want to dive into a
Yeah.
few examples.
Okay, so I'll talk about the three key things and what I decided to do, Sean, because I had to change brokers, and the current broker that I'm with doesn't have the equities available. So
Hmm.
I looked at the indices. So I have the Nasdaq pulled up, the S&P, and the Dow, something everybody can relate to, and so I'm going to analyze that here in a second and kind of show you what I
Sure.
see and what I think may happen, and then we'll see what happens over the next few weeks or whatever. But the three things to kind of keep it simple, like a preacher, are mindset, mentorship, and a methodology. And it's not in any particular order, but you have to have those three things, that trifecta of things I think, to have success as a trader. So your mindset, which we talked about, You've got to have a method or a way of actually approaching the markets that's repeatable. And then you need mentorship because um, very few people have 3 years to learn how to trade. I mean, you may, but you like life happens. And so, that person, that guide, very much like your platform, Sean, I love the way you really guide people through the process of how to evaluate it and make selections. And so it's the mentor, it's a form of mentorship, and people need that. And that was one of the biggest things, going back to my history. When I was I was a lieutenant in the Army. I was very entrepreneurial, aggressive, looking for opportunities, but I didn't have mentorship. And so I had the mindset and I was looking for a method, but I think if I had a mentor, I could have found the method. And so well, the method was entrepreneurship, but I didn't have a mentor to show me where to go and
Mhm.
actually execute it. And so the mentorship is very important because a lot of times people want to skirt that. It's almost like saying you don't need to go to college. Well, college just is college. It's what you do with it or what your intentions are that make it whatever it is, right? And so it's the same thing with this. You have to get somebody who's been there before and can help guide you and has a personality alignment with you as well. It can't just be anybody. There has to be some type of alignment to where you want to listen to them and you respect them enough to listen to what they're saying. But those three things I think would fast track any person in any market as a trader.
Nice. All right. Well, methodology, we're going to dive into that right away or
Yeah,
start at the
yeah. Let's
top?
let's let me see if I can hold on. Give me 1 second here.
Sure.
I'm gonna pull up this chart
What,
and we'll see what we got going.
just curious
Go
here,
ahead.
because the audience may be curious as well. What broker did you switch to and who did you move to?
Okay, so I moved to a broker called IG. They're out of Britain. They're out of Britain.
Okay.
And I left a firm called FX Choice, which was out of Belize. And so it's a big difference because the IG platform, although they're out of Great Britain, they have a US based because the rules in the US are very different. And so after the
Right.
Dodd-Frank Act was passed, a lot of things changed in Forex as far as US based brokers. And so I have a lot more limitations than I had before, but I have some other US based accounts anyway. So I was kind of used to it. But when the company in Belize, they changed, they're pausing their operation because crypto regulations are shifting as far as how they can receive funds, and so it kind of upset their business model. So we had to leave them. But I had a lot more. Like you can do a lot more with trades that trade and they were regulated, but they just weren't U.S. based. And so I'm with IG now. IG US I think is their platform or whatever, but they're pretty good. So anyway, so
Sure.
this. All right, so this chart right here is the NASDAQ 100, NDX 100, and what we've got, what I'm going to do is what I did was I marked this little blue line here. I already did kind of a take profit analysis of where I think if it does what it looks like it's going to do, that price will probably fall back down to this blue line. So let me kind of tell you where we are, what I see, and then I'll tell you how we kind of got to what I see. So right now, where this crosshair is, that's the current price of where the Nasdaq is. So it's like 16,349.80, somewhere in that range. So for for me, what I'm looking for first is, do I see what's called the price cycle structure? And so what a price cycle structure is whatever direction that the market is moving. So as we can tell from the lower left all the way up to the upper right, clearly the market is trending generally upward. Would you agree?
Mhm.
Okay. And so at a certain point, these red and green candles, if you can make those out, the green candles, when you're talking about the market going up, is bullish behavior. So the market is bullish and it's charging ahead. The red candles are what's called bearish behavior. So the market is kind of pulling back and being more defensive. And so for the market to trend, you have to have a combination of the behavior, in this case, the bullish behavior and the bearish behavior. I call those extensions and pullbacks. And so the market is extending in a direction and then it has to contract and pull back. And then it extends and pulls back. It's almost like breathing. Like if you're running, you have to gather your oxygen. And so the pullbacks are like the oxygen for the market to continue in the direction that it's moving. And so the deeper it pulls back, not too deep, because too deep a pullback could signal a reversal in trend, but a decent sized pullback, and that's a little more technical than we're going to get here, will allow the market to continue to trend in the prevailing direction. And so at a certain point, as long as the market, so let me define what a trend is, because a lot of times people don't really understand what a trend is,
Mhm.
technically speaking. So when the market trending up, as it is right here, this red candle in the center of the screen, once that happened, that means that closing price was lower than the previous candle. So I'm going to touch on this candle and see if it comes up, if I can get the price to pull up.
Yeah. And
And
is it possible to maybe zoom in a little bit?
absolutely,
Yeah,
absolutely.
that'd be
Thank
great.
you. All right, I was wondering. Thank you for asking. So is that better?
Yeah, it's much better. You can make out
Okay, oh,
the candlesticks, the colors.
gotcha. Okay, so right here, the market is clearly trending upward. You have these green candles, and then the red candles are the pullbacks within this upward moving trend. And so when I click on this candle, it's going to give me an opening price, a high, low, and a closing price. That's what a candlestick is comprised of.
Mhm.
And it's all within a certain time frame. So this one, I don't know what time frame I'm on. I'm probably on the daily. Yeah, I'm on the daily right now. So this is a day's worth of activity, this one green candle. And so a pullback happens once the closing price of the next candle is lower in an uptrend than the previous candle. So now I know that prices started pulling back once I saw that red candle. So just to show you what I'm talking about,
Mhm.
I'll try to click that real quick. See what we can get here. Let me zoom in a little bit more. It might be easier to do what
Sure.
I'm trying to do here. Okay,
There you go.
so there you go. All right, so there it is. Okay. So you see here, it gives you the time, and this is don't worry about the time because it's not going to show you your time. It's like GMT. But the opening price for the NASDAQ was 11,985.33. The high of that time of the day was 12,245.33. The low was what it is. And then the closing price, you can see, is higher than the opening price. So the open is 11,985. The close is 12,160.08. And so you can tell that price moved from here to up here. Now, when you go to the red candle here, it goes opposite. So it opened up here and it closed down here. And so when I click on that one, the opening price is 12,146 and it closes 11,931. Now, until price comes back and eclipses a prior pullback point, price is still trending. So you can see here, these now it pulled back here, but these candles were trending. You had the red, green, and then at a certain point it extended, and then the red candle over here was lower than the red candle over here before at the previous pullback point. That is technically what I call a trend invalidation. That means the trend is actually technically changed from an uptrend to a downtrend. Now you can't you should not just make decisions based on the market changing directions. There are a number of things that have to happen for you to confirm whether that's legitimately going to stick. So for me, what I do is I'm looking at a chart and I'm saying, okay, I have a trend invalidation here, and knowing that the first trend invalidation in most cases is the least reliable trend invalidation because it's the first piece of data saying that the market wants to go a different direction. I'll wait for it to pull back and retest the previous extension point and then see what it does. And so as you can see here, price rejected off of this. This is called an exponential moving average. It's basically an EMA. It's the average price of time. I'm sorry, the average price of the NASDAQ over a certain period of time. So this is the 13 EMA. That means over the last 13 days, this is the average price. Okay, so that's all an EMA is the average price over a certain period of time. So it came down, touched this EMA, and then came back up here. And I literally would check the candles to see what the close is because it's that important. The closing price here was 12,703.92, and the closing price over here when it was an uptrend was 12,691. So it actually technically became an uptrend again. And so that's why you don't take the first signal that you get. You have to get a confluence of events that occur. And so you have the TI short, the trend invalidation short, level one, pull back and create a trend invalidation long, and then it pulled back and created a trend invalidation short. And so at this point, it's a little bit more noteworthy, but you have to be mindful of, what the overall prevailing trend is. And there's some other things, you want to look at kind of the totality of the market. So you don't want to just look at that, but you could have at least maybe taken this trade and so if I would have priced this out and looked at it, I normally do a calculation that says, okay, this trade is probably not going to give me what I need in profit to take the risk that it's going to take for me to get that profit. And so I look at those factors, and I'm looking at the overall trend of the market, which I'm going to zoom out here so we can kind of look at that. The market's been trending up for a while. So for me, when I see these EMAs, they're kind of like support steps when the market is going up. When the market is when it starts pulling back like it did, let me X here. So this is where we were, and I'll get back there in a second. But I'm sorry, yeah, we were right. That's not where we were. Hold on, we lost it. I need to go back a little bit. Okay, where were we? No. Oh, we were right here. That's where we were. Okay, we were right here. So so price moved back, but it's basically moving back into what I call consolidation. And so I wouldn't normally take that short because it's not breaking away anywhere. It's really just kind of coming back into where the market was previously. And so when I talk about price cycle structures, I'm looking at, okay, what's the trend? But then where are we in the cycle? And so what the cycle looks like, I'm going to move over here and use this example because it's filled out. The market is trending, and then it will invalidate the trend. So like it did here, this red candle here is lower than this previous pullback candle here. So that's technically a level one short. But what I see is I'm looking at this and I'm saying, okay, what price would normally do is invalidate the trend, pull back. Let's say using the example of the uptrend, it'll extend the low again, maybe once or twice, and then it'll pull back, come back up into this consolidation zone. This is where price is moving back and forth sideways. That's called consolidation. There's no trend direction. So a price structure will look like, okay, we have the trend invalidation, an extension of price in that direction, coming back up into consolidation, and then coming back long, which it did up here. And then now I feel like, okay, now price has filled out most of the structure. It's given us a trend invalidation, and it's composed of a pause, a trend invalidation, an extension in the direction of the invalidation, which it did. So it gave us a short move, pulled back, two more short moves, came back up into consolidation, and then it went long. And so at that point, the first basically majority of the cycle structure is completed. All we have left now is for price to go up maybe a couple or two or three levels, and then come back, generally to come back into this consolidation area again and determine where it wants to go. So we have this here. I would have, taken this trade here with the safest place to set your stop would have been down here at where the market, at the part of the cycle. But a lot of people would have just taken it at the previous pullback point, so they can get a better, risk on or reward on risk. And then I'm gonna zoom in here and kind of slow down. If your reward is not at least 1-to-1 for risk, then you should not take the trade. And so what you're generally trying to do is balance your greed and your good sense to make sure that you don't screw yourself over when you're taking these trades, because everything is high potential until you lose money. And so so right here where this bar is, that's where you would have been able to take a long trade. And so I'm going to go down here and I take it to the bottom of the wick. So that 43218, that's 4,321.8 points away, because these are daily candles. And so I need at least 4,321.8 of upside to make this a good trade for me. So I just physically do it. So 4128, whatever. Okay, we just go to 40 right there, 4,200. So I'm saying, okay, I can probably get there. 4163. We'll put that. So I'll create a stick. 4163. Sorry. Well, I'm sorry. No, I'll just leave it right
You're
there.
good.
Okay. And I will I'm going to stop that. All right, so I'll put that there. And let me check, make sure that was right. So going down here. Okay.
So what you're showing us here, is this an entry point, a buy?
Correct.
Okay.
So this is an entry. And
Okay.
so when price moved up to this gray bar, it gave us an entry because it went back long. And so I'm looking at the previous pullback point for my stop loss. So 42.22, let's say, and then I need to go 42.22 this way. Let's say 42.93, 16.250.59. So I'm going to make this 16.250.59. And what I'm doing is I'm actually just setting an arbitrary take profit that says, if I get to this point, the trade will be worth it. And you can see that it went through there because we were kind of in the future, but we're gonna back into this and see what, if we could actually take the trade. And so I'm gonna mark this so we can all know what we were looking at. So right there, that's good. So that blue line is where we would have been taking the entry in the perfect case. And so what I'm going to do is go backwards in time to see where I would put my take profit. And so what we've got is, I'll zoom back in here in a second. I'm just kind of looking at it. What you normally do is these little lines on the screen, I'm sorry, these little check marks on the screen, those are called fractals. And that's probably not the actual perfect term for it because it's not really a mathematical fractal, but what it is an inflection point in the market. And so these little markers show where the market reversed and changed direction, even if briefly at a certain period in time. And so why those are important is because anytime you have an inflection point in the market, generally speaking, you're going to see the market change direction, even if briefly. So this pivot point right here, this what's called so-called fractal, you can see it. It's actually it's defined by, if the trend is up, is defined by a candle with two lower candles on the left and two lower candles on the right, because it's got to create a peak. And so this candle right here is the middle candle where you've got these two on the left and these two on the right. So it creates a fractal or pivot point. So what that means is you can tell price immediately almost like hit a brick wall and then retraced. And so what that tells me, that in the midst of the market having demand, which means that it's rising in price, there was a supply area to where supply overtook demand even briefly. And so supply of the availability of NASDAQ at this price was too much. And so it retraced back down this point until where you could find buyers again. And so every pivot point is really an indicator of a change in sentiment in the market. And so that's why they're important. And so what I do is I use the pivot points as my basis for setting my take profit, because what I want to do as a trader is try to make my approach as scientific and as logical as possible. I don't want to ever be including my dirty thoughts into the market. I want to put garbage in so I get garbage out. So I always use the information that the market is giving me to make my decisions, including my take profit. And so this entry here, like we said, we had 42.22. And so what I do is go back in the past from where I entered, where I would take the trade, and I'll look at all the pivot points before that, and then I'll mark up what my take profit should be. So this is going to be a little, I'm gonna have to zoom out, so it's going to probably be a little hairy here for a second until I can see what I need, because I didn't do this up front, so I just wanted to kind of walk through this with you guys. So you can see we got in up over here, and so I would look at this pivot point here, 15.94345. So I'm going to calculate this as we do it. 15.943.45 plus going back and going all the way back over here. So I go all the way back in time, and then I click on it to see if it has to be higher than the previous pivot point. If it's not, I won't take it. So this pivot point looks like it was a little bit higher than the other one. So let's see if I can zoom in there. Just going to skip that one. Matter of fact, I'll do a little chart thing and see if it's going to work. So we've got this one here. Okay, so it's higher than that one. So I need to put that one on there. So I'm going to zoom in for a second and go back and do this. Okay. So that pivot point is getting messed up by the Bollinger Band. So let me go look at the candle. The higher the candle is the same as the pivot point. So 16,009.67. So 16,009.67 is the second pivot point. The third one is up here, which is 16,563.65. 16,563.65. 63.65. And then the next one up is this one, 16,657.59. 16,657. So what I do is, as I see a trade setting up, I'll start doing these calculations in advance. So that'll give me a kind of a heads up on whether, first of all, I want to take the trade, or if the trade is still legitimate, do I need it for it to pull back a little bit so that I can get a better entry point? All these things you can do ahead of the trade, which is part of the reason I'm what's a so-called maybe a swing trader. So my trades, I don't normally trade on super low time frames. I trade kind of the hourly, the 4 hour, and generally speaking, maybe the 15 or 30 minute. But my trades will play out over several hours, so maybe a couple of days at a time. 16766.72. And so you do that, for me, what happens is now I don't have to rush to make a decision because we don't want to rush to failure because everything counts. So 1, 2, 3, 4, 5 fractals divided by, okay, equals 16,388.22. So now 16,388.22 is the price, and that's higher than why I set that marker. So I would change this 16,388.22. Now is moved to the proper place. I would set that as my take profit. And I'm gonna zoom in now. And so I would set that as my take profit, and I would have this down here. And I'll change the color. That would be my stop loss. And so now I know that I have at least 1-to-1 reward for the amount of risk that I'm taking on this trade. And it's backed up by the math of the fractals, which, because I took the average, I just basically created my own moving average here, and price, I'm expecting to hit it. So after 3, 6, 9, 12, 15, 16, 17, 18, basically 19, 20 days. So basically almost all month, it finally hit the take profit, and it moved up, over 4,000 points, and you caught that uptrend. And so now, so that's what I normally do when I'm looking at a trade setup. I'm looking for the price cycle structure to complete, which is a move in a direction, a trend invalidation, and extending in the direction of that invalid trend, coming back up into consolidation, and then reestablishing the prevailing trend. And that's when I can get into my first trade safely and confidently and know that I have a low probability of getting stopped out. And so very few of those occur they occur when they occur. And so you've got to have the patience to wait for them. But just to analyze the NASDAQ, because I know took a lot of time on this so we can get into some questions. The NASDAQ is right here right now. So it's at 16,308, 311.68 or whatever. And so what I do is before I'm taking a trade, I normally mark up the charts with what I call vectors. And so I use the fractals, again, the pivot points, to create these vectors. And so when market was down here, I'll go from the lowest point to the next midpoint, and then it kind of creates a trajectory of price. And so what that is a projection letting you know that when price moves above the vector in an uptrend, that is still continuing to rise. And so once it goes across this vector, it's actually losing momentum, and you have to be mindful that it may turn around on you. And so what you're looking at is this gray line is a support and resistance area, or supply and demand zone, as some people call it. So you have horizontal kind of lines, and you've got the diagonal lines that you draw out for yourself. And so when price move back down, basically it's going to normally find a support and resistance zone. And so price decelerated through this vector, came back and hit this support and resistance zone. And so it took a little break, and then it continued back high again, and you could have taken that long and set your stop down here. And probably would have made some money on that. So, but what happens is once it goes to the other side of the vector, you have to be mindful and continue to draw vectors to see if price is decelerating or not. So as long as it stays on the uptrend on this side of the kind of like using that as a stair step, is good. Price is rising, but once it falls through there, that means price is starting to lose steam, and you have to be mindful. And so what I do is, I'll draw vectors along the way and kind of show me what price is doing. And so up here, this last vector that I drew, I see that price was following it, and then it broke through there. And so now that price is broken through here, what I'm looking for is a pullback, because we have a trend invalidation. Like I said, we had this pullback, this extension higher, and then you can see that the closing price eventually eclipsed this previous closing price of the pullback. That's the technical definition of a trend reversal. And so since trend is reverse short now over the last couple of days, which you can tell the market's been down, listen to the news, it's been down the last few days. These are the candlesticks that show the price where the market has been. So it's technically in a downtrend right now, the NASDAQ, but I'm expecting probably over the next few days, probably going into next week because we're at Thursday, that price could pull back, and then we'll have a couple positive days going into next week. But if it holds and doesn't move higher, and the further away it gets from this vector, the less of a chance it is that it's going to go up here. So I would expect price to pull back maybe over a day or two, and then I would expect price to continue to drop back into this area first, this consolidation area where we have the support and resistance. And then I would expect it to actually drop further because just based on what I know, I'm looking at how far this extended. The Forex market is very much a zero-sum game. And so when it's going so far in a direction, the math says that it has to revert back to the mean at some point and go in the opposite direction. And so we have this amount of movement higher. I expect at least that amount of movement lower. So I did calculate this one mathematically, and this is the take profit that I have. So if price stays where it is, it does what I think it's going to do. What I see is the NASDAQ moving higher, maybe not today, but maybe tomorrow off of the news. You know, we got unemployment numbers coming out tomorrow, so that moves the markets. So depending on what unemployment says, price may come back up here, or it may completely shoot just straight down. You never know. So you just got to watch for it first. So I wouldn't take this trade just because it's a short. I'd wait for a confirmation that it wanted to go short, and then I'm definitely more buying short than I am long right now. And so I would, you know, after a couple of days, and maybe I'll put a video out on it, depending on what happens over the next few days. If it comes back up here and it gives me what I'm looking for, then I'll tell you when it's a good time to short. So let me pause there real quick. Sean and I talked about this. Sean, you remember we were saying, okay, well, some people like you really shouldn't get into shorting. And so what you do, if you can't or won't short the market, what you can do at least as a risk management strategy is not be on the buy side, right? And so if you're thinking about getting into a trade or buying into an equity or anything, an index or an ETF, whatever it is, because they're all the same as it relates to charting. If you see that it's giving bearish behavior, then you can wait for a better entry price. It doesn't mean that you don't buy it, but you can wait. And so that's your version of shorting, because the money that you save by not being upside down on the trade or the investment is the exact same thing as actually making money on it, essentially. You know, I mean, it's unrealized, but you realize not losing money by not taking the position. And so that's kind of a workaround to not being able to short. And so I wait for price to move up here, confirm, and then I'm looking for it to fall back into here and then here. And this could be, I mean, this is a daily chart, so this may be over the next few months. We don't know. You know, it could be several weeks before this plays out. But I definitely expect price to come back down into this consolidation zone, and that would complete the complete structure of the price cycle. So we would have the TI short, the extensions downward, moving through consolidation, extensions upward, normally 1, 2, or 3, and we got 1, 2 good extensions is coming back, and I expect it to pull back down into consolidation right here before touching down here and then maybe going back up later. So definitely looks like we're going to have some bearish behavior in the market over the coming weeks, and that's kind of how I analyze it. So you can do the same thing. This is the US 30. This is the Dow. They generally behave the same. It's showing bearish behavior as well. Hold on, let me scroll in. It's showing bearish behavior because it's crossing the vector and it's losing steam, but it's not as bad as the NASDAQ. But this is actually still an uptrend because it hasn't actually it hasn't crossed the TI. It hasn't crossed the previous pullback point, but it's showing that it's losing steam. And then this is the S&P, and I'll kind of pull back for questions. It's doing the same thing. It hasn't completely gotten down and validated the trend, but it's showing bearish behavior. And so it may be the course of the day before it does it, or it may not do it at all. But all the indexes are showing weakness. And so I'm expecting over the next several weeks, there may be obviously there'll be some up days in there, but I'm thinking overall over the next 2 to 3, maybe the next month or two, I wouldn't be surprised if price drops significantly on those. Now, if I could be wrong, everybody else is happy because that means the market went up. But that's basically how I see it. So
Sure.
Anyway, all right.
Let's keep it right here. I'm looking at what looks like August 17th.
Okay.
So if you move your cursor over, yeah, to the left.
Okay, right here.
Yeah, exactly. Go straight up.
Okay.
What you see here, like if somebody doesn't know what they're doing, they may think about buying right there, but then there's an issue. If you go ahead to, it looks like September, October, it falls off a cliff.
Right.
So how would you avoid that? By looking at that August 17th time period? Because some people may say, hey, it's starting to move up in the right direction. It may take off, and then you can lose a bunch of money. So
that's a great question.
Yeah, what are you seeing there as an issue to tell you, nope, that's not a buy point?
Okay, good question. So let me look at this and I'll just talk through it because I haven't analyzed it to that point. But I will say the first thing, all right, first of all, I see it's trending up, and that's okay. but I would probably set this blue bar is actually where I have the take profit. It's actually a very good support and resistance zone. So price was actually hovering around this price point, the 43.7928. This is the S&P 500, by the way. And so I see that as a point of supply and demand change on both sides. So anything could happen. And so the first thing I'm looking at is, okay, it's trending upwards, and then it invalidates the trend right here. So at that point, I'm looking for some type of confirmation that it wants to continue short or going to turn around and go long. So what it does is it falls in, it pulls back, and then it does give some more bearish behavior, but it's going down into the support and resistance zone. So what I don't want, unless I'm trading a lower time frame, which on the lower time frames there are probably some short opportunities that I'm maybe taking going down to this point. But as a swing trader looking at it on the daily, I'm saying all it's doing is coming back, reverting back to the mean. It's not giving me any indication. It's going back, and really it's going back into the madness. So this is the worst place to try to take a buy trade, because you're not on the edges of the market. And so, side note, generally speaking, when the highest probability trades are going to be when you're taking them at the edges. And so that's when you're setting a trade and you're using the low of the day or the low of the session or the low of the whatever as the kind of the low end stop out point, and you're above the previous high of the day or high of the session or high of the period, and the market is giving you all of that. And so that's where the patience comes in, because you have to really allow this price cycle structure to play out to give you a good chance of actually winning before, without going through all the BS that can happen. And so, not that you can't make wins in that, but as long as there's confusion and static, that's not, you really don't want to be trading from in here, generally speaking. And so because it's coming back into this supply and demand zone, I'm really waiting to see what happens here. I want to see if it rejects this. As you can see, it came through the blue and then it rejected it, and then it tried to go again and it rejected it again, but then it came back down. So it's showing me that it really wants to go lower, because it's tried to go lower twice, and it never really shot above where it was previously over all of these days. And so there's a technical aspect to it, and then there's a common sense aspect to it as well, because you're saying, okay, as we all would probably agree, a bar of data on a daily time frame is a lot of data. And so, it's not a lot of data on a 5-minute chart, but it's a lot of data on a daily chart or higher, because that's a lot of information that's happening. So this is really a very good indication. Another reason why I trade higher time frames, a good indication of what the market is really feeling, the overall psychology of the market. So the market was showing bearish behavior, but it wasn't ready to go lower, but it was definitely showing that it wanted to. And because it couldn't push higher, I would probably take note of here and see if it wanted to keep going lower. So, all right. So honestly, what I would do, I would look at this trend invalidation, have the pullback. I probably would have missed this trade, even though I could have probably taken one off of here on a lower time frame, because it's not giving me enough information to take this trade. So once it comes down and it establishes what's called a level 2 short. So this is level 1, pullback, level 2 short, pullback, level 3 short, his consolidation zone. And then normally after about 3 pushes, the market will reverse. But the more pushes that a market goes in a direction, generally speaking, the higher probability that it's going to reverse, because like I said, it's a zero-sum game. So I'm looking at this, and I would not have taken this trade because, first of all, the way that price is crashing into this support and demand, supply and demand zone, I don't like it. When I have something's called a waxing bearish move, and I use waxing and waning because I think about the phases of the moon. And so like when the moon is when you see the curve to the right is waxing, and when it's curved to the left is waning. And so when I see a waxing kind of price waxing down like this, and with like a little bit of a curve, I know that generally it's going to pull back on me pretty severely, and it did that. And so I'm waiting to see what happens next. And so at this point, I probably would have actually taken this trade short, because it came down and closed here. Well, actually, I shouldn't have taken it short. I should have taken it short here. And I'll tell you why I wouldn't take it short here. I would have taken it short right here and saw what I could have gotten from this being the pullback point. I mean, the stop out point, 2219.6. And it would have been really close. So I would have had to really be on top of this trade, because there was not a lot of reward for the risk on this. So that's another thing. If the reward to risk ratio isn't a clear one, I wouldn't take it. But I see that it wants to go down. So I mean, it's telling me it's in a downtrend. So you shouldn't be trying to buy here anyway, just from a pure technical standpoint. Level 1 short, level 2, level 3 short, you should not be trying to buy anything here. And this is probably what people were doing. They were trying to buy off of this level, and that's why they got screwed, and then they end up losing their money. I guarantee it, because you probably set your stop at best down here. I'm sorry. You probably said you stop
Real
at best and
real
move
quick
there.
here, I'm starting to see some comments come through.
Okay.
Leo mentioned return to the scene of the crime. Have you heard that in the trading space before?
Oh, yes, I have. Right. And so, but price has memory. And so you'll see it behave similarly once it
Mhm.
goes back to the scene of the crime, essentially, and you can kind of see what happened and see what it does after that. So I would have been looking for potentially a short trade on this. But
Right.
after the third bounce lower, I'd be kind of afraid to do it because just so much happens. Like all these things are kind of going in my mind at the same time. But it's already technically in a short position, it's just
Mhm.
not the ideal short. I wouldn't be trying to buy out of here just because it came back in here. So that's what amateurs do. They say, okay, well, there's no way it's going to go back down. It's back here and it's green again. And so like you don't have a methodology for looking at whether or not to take a trade. And so I'm looking for, is it clear and compelling for me to take this trade? Is the risk to reward 1-to-1 minimum? And what am I trading back into? Like you say, if I'm trading back into consolidation, um, or if I'm in the middle of consolidation, I give myself basically a 50-50 chance of winning, right? I mean, because we're here in the middle in all the confusion. And so if anything I'm doing in here could go either direction. And so I generally that's enough to keep you from doing it. But at least if you're taking a trade, kind of know how to get in and do it. But I definitely wouldn't be buying out of here because they're saying short. So anyway, it went short and continued down, and then it became a level one long. You see it popped right back up to the same level again. And a lot of traders will say, okay, now I'm going to get in because it's long. But it hasn't confirmed anything. And so you don't have any basis to know if this is a strong enough up trade. And so every time you hit a supply and demand zone or a price vector like this diagonal vector here that I create, um, anytime it crosses one of those lines, even in EMA, because an EMA is basically a supply and demand zone as well, is going to retest in general in most cases. And so once it came down and it pulled through this supply and demand zone, it eventually retests that. And so what we want to do is I have a number in my head. I want 4 to 6 legs of movement on the other side of a move through an average. So when price moves through this average down here, I'm looking for one rejection, and then I'm looking for another move in the other direction if I can get this horizontal line off of there. Okay, so one rejection, 2, 3, 4, 5. Um, and so at that point, I could get into the trade because it's a level one long. It's the fifth leg of this, what's called complex pullback, which is basically price figuring itself out. And I have the edge of the market now to go off of. So half of the price cycle structure is formed again, like I was talking about. Price trended up, it invalidated the trend, came back into consolidation, went lower, 1, 2, 3 pushes lower, came back through consolidation and gave me a buy trade on the fifth leg of this complex pullback. And so now, since I have the bottom part of the price cycle structure formed out, I would take that trade. And if I was really feeling good about myself, I'd take it there. But if I want to be conservative, I take it down here and use my fractals to see if that was a viable entry for risk reward. And so if you buy here, what was it, 3064.7? So 3064.7 is how high we need to go. It definitely clearly did that. And so that would have been a viable trade. So I'm waiting on the structure. I'm looking at the structure of the market, the price cycle structure formation. I'm looking at supply and demand zones. I'm looking at the vectors,
Mhm.
and I'm looking at the velocity of the moves, right? Because the more violent the move, the greater the chance the price is going to reverse in a violent way as well, because it's a zero sum game and you have to get that oxygen back. So the faster you run, the harder you breathe. The slower you
Mhm.
run, you don't breathe so hard. And so that's
Right.
kind of the momentum of the market, kind of to put it in layman's terms of what you're looking at. So I'm looking at the structure, I'm looking at supply and demand zones, and I'm looking at what's the highest probability entry I can get based on what it's telling me.
Mhm.
That was a lot. So I'm just kind of
It is, and audience, you can definitely see that technical analysis is very technical. There's even a lot in here that's a little over my head. I'm like, I would have to really dive in to learn how to trade correctly because there are a lot of people that are trying it, and as we know, it's like statistics are there. It's like 99% of traders lose money.
right.
Um, so yeah, it does require a lot of education. Let me get into that a little bit. I'll ask a few questions here, then I'll turn it over to the audience. How much time are you spending per day trading?
Great question. So I'm up around 4:15, 4:20 in the morning.
Okay.
And I try to catch the back part of the London session. Just, I mean, I'm just up in general, but like I catch the London session to see what price is going to do. Because normally around 5 Central, 5 or 6 Central, 4 or 5 Central, whatever, the market is going to make a move. And so I'll look at the market. If I'm not in a trade, I'll analyze and say, okay, how long does it look like I have before a position is going to form out? And so what I'll do is set alerts. I'll go to TradingView and I'll set some price alerts. And once it notifies me that prices hit a certain point, I'll come back and look at it. And so normally what I'll do is it completely depends on where the market is when I'm in it. So if it's completely out of whack and I say, okay, I'm looking at this and there's no trades here, then I'm just walking away and I'll just check in on it from time to time, just maybe over the course of a day if I think there's going to be a setup. If there's no setups, I just cut my computer off and I go on about my day. If there's a setup that I've taken, normally speaking, when I enter a trade, if I give myself permission to enter a trade, in most cases, sometimes I do dumb stuff just like everybody else, but most cases, I take the trade, I have a time frame built into how long I'm going to let the trade so-called bake, right? And so for me, I call it the 16 bar theory. So I break up a trade into increments of 8 bars, and then the second 8 bars I break up into halves. And so if I take a trade on the 1 hour chart, if I see a 1 hour setup, when I take that entry, I just set an alert for myself to check it in 8 hours. Now, of course, I'm human, so I'll check my phone and look at it from time to time, but I'm not glued to my computer. I'm literally in meetings. You saw me with my son. We were at the donut shop the other day.
Mm-hmm.
We just, I'm living my life. And then when my alert goes off to check the trade, I'll see if it's done baking. And so after that 8 bars, and so the 8 bars, it doesn't matter what time frame you're using, whether it's the 15-minute, the hour, the daily, it's just 8 bars of activity on the time frame that you enter the trade. And so if I got in on the 1 hour, I literally have 8 hours before I even need to check the chart, because what I've realized in the kind of the data that I analyzed was that most trades aren't going to give you everything you want very soon, like very early. So what you want to do is separate yourself from the trade, because the more you look at it, the higher probability chance is that you're going to go and manipulate it, right? It's kind of like looking in the oven when you're trying to bake a cake. Like you see something and you're checking the temperature and you're like, oh, maybe I need to do. And so you start screwing around with something that your
Sure.
best chance of winning was when you didn't have a trade on, right? I mean, so you want to be like, you want to let your emotionless self, and I mean that less emotional self, actually do the analysis, look at the risk reward, look at the stop loss, look at the take profit before you actually have anything invested. It's almost like the guy, I go to Vegas. I told Sean, I go to Vegas to be financially responsible, right? 3-4 times a year. And so when you're at the blackjack table, or you're at the craps table, like as long
Okay.
as you're not playing, you're calling all of it, right? You're calling the sevens, you're calling the hard eights, you call, I mean, you're blackjack and you tell them when to hit. Like, I mean, you can do no wrong because you have no money on the table. But as soon as you put one coin up there, when you put one chip, your whole mindset changes, because now that caveman aversion to loss comes in, because loss is like death to us on some fundamental level. So now you change your decision making. So the same thing as a trader, you want to do that. I want to take my entry. I want to get the hell away from it for a little while,
Yeah.
and then come back and check on it from time to time. And then after 16 bars of activity have occurred, I can normally I can ascertain whether I want to stay in the trade, take my small gains, take my small loss, or let it play out for me to go to where I think it's going to go. But I don't do it. I don't sit there and watch it. So I would say probably of actual trading, I may actually physically be interacting with the charts from like an analysis standpoint, maybe 2 to 3 hours a day max. I mean,
Yeah.
like of actually interacting, and then I check on it from time to time. So that's where you want to be. You don't want to be in front of the charts all day, because being here for 8 hours is worse than being in the gym for 2 hours. I mean, mentally you just are drained, and so it's not a good place to be, and it's not healthy. And so you need to be away from your screen as much as you can, so that you can have a higher chance of success.
Right. With that 2 to 3 hours, does that include some of the research? Because you're looking and analyzing at a lot of different movements, and then you're making some decisions.
Correct. Yeah. So what I do is it's almost kind of like when you go into surgery, right? So the anesthesiologist doesn't show up until you're ready to go down, right? And so I'm checking the conditions, and if the conditions aren't giving me what I want, then I just leave it alone. But if the conditions
Sure.
are forming, then I take a little more time to say, okay, what are the possibilities, probabilities of it hitting this point? And that's where price comes in. And I set my price targets because everything that we're looking at on the chart is identified with a number. And so I'm like, okay, if it gets to this number, it's at least telling me that it's doing what I think it's going to do. If it never gets to that number, then, and I don't get an alert, then I don't have anything to be looking at in the first place. And so the reason, that's also, as a side note, the reason that I only trade one currency pair at all. I trade the British pound versus the Japanese yen, which we discussed, because you have to lock in because of all the nuances. You need to learn the personality of what you're trading. And so we talk about the analogy of dating, right? So you can date a lot of different pairs, you can date a lot of different people, get to know a little bit about each of them, have a little fun, take some wins, take some losses, and that's cute when you're dating. But if you're trying to have some long-term success, at some point you have to lock in. Now, I mean, I'm not saying you can't be polyamorous. You can have 2 or 3 pair that you want to trade, but you don't want to have 20 pair that you're trading, right? So you lock in and you start to learn the personality of that pair, just like you would a partner. And so when you learn the personality of the pair, it becomes easier to kind of project what it's going to do next. And if it's not doing that, you have a very good indication that it's not going to do what you want it to do, and then you don't have to deal with it. And so like locking in and really narrowly focusing your energy on 1, maybe 2 pairs at the most, it really gives you an edge because now you can learn kind of the cycles and how they happen, and that's what keeps you away from the computer.
Right
So
on.
yeah, you're right. 2 to 3 hours, and that may be, it's normally front loaded. So the first part of my day is probably where I spend the most time, between 4 and 6 in the morning. And then if what will maybe extend it is, maybe let's say there's a news announcement, like we got non-farm payrolls on tomorrow. And so that's, I think it's between 7 and 7:30, somewhere in there. So if I'm in a position before a major news announcement, I'll normally, if I'm in profit, depending on how close to profit I am, I may just cut the trade off altogether. If I'm not in profit, I'm generally confident that it's not going to knock me out. I'll just leave it on and let it play through the news, and then it'll figure itself out. But if I'm not in a trade before a news event, I generally don't take it because the news distorts the information. And so you don't want to be the truth of what's really going on normally happens an hour or 2 after a major news event. And so so you don't want to be on the front end if you haven't taken a position, because even if you're right, the market can make you wrong just in that one moment of time. So I limit it to maybe 3 hours a day, and the third hour would normally be if I'm waiting on a news event to happen and pass before I take a trade, if that makes sense.
Sure. Gotcha. I'll get to, I know some of you are dropping questions here. I'll get to those in a second. Another question would be just to set expectations for the audience. What are your average returns per year trading?
Oh, great question. So this last year, I was trying some different things out, and I think I came out at about a little over 200% this year.
200% in 2023?
Correct. 200, a little over 200%. So
Okay.
and and that's, taking no more than 5%. Like I take generally about, the upside is maybe 3.75% risk per trade is the highest I take. Low side, maybe, less than that, maybe about 1.25%. And so like, I don't take a lot of risk, but I manage my entries really well. And I'll take multiple positions on one setup. So let's go back and share the screen real quick, and I'll
Sure.
show you kind of what I'm talking about. So when I'm taking a setup, normally what I'll do is, and I saw somebody mention, how do you know if it's trending up or down on the monthly? I'll answer that here at the same time once I get through kind of making this point. So I'm going to look at what I'm actually trading, which is all right, hold on, let me see if I can find the British pound. Sorry, I'll just kind of stay where we are. I won't screw it up. So, all right. So what I'm doing is, when I see this trade up here that, like I said, I would have taken, there's trades that are happening on lower time frames that I can take as well. So what I'll do is, once I see it established, oh shoot, I had it on there. Okay, so this is where, price had to start somewhere. So it started, I really screwed it up now. I don't even know where I'm at. Hold on, let me find it. Where were we? Were we in, okay, we were in November 23. So November 10th, 2023. Okay, that's what I needed. November 10th. So on November 10th, I see that the daily, it started back at the end of October, but we're kind of looking at it, and I'm saying, okay, what am I seeing on the lower time frames? And so we go back in time. So we say October. forgive me, I got to just kind of cruise. So this is kind of where we were. This is with the market bottoming out. And so this is the 4 hour chart. So it's still not super duper, high risk, because 4 hours of information is good as well. But what I see here, I'm gonna zoom in. I'm actually gonna mark my spot so I make sure I don't lose it. Change the color so it doesn't look like anything else that I have on the chart.
Mm-hmm.
And then, all right. So now I know when I go back out where I'm looking for. So here on the 27th of October, before we got up to this point, we had the market had bottomed out, and it was showing us that it was trying to reverse directions back long. And so I see a buy trade right here. So it moved up into a level one long, retested 1, 2, 3, and then 4. The fourth bar I probably would have taken because it showed me that it wanted to continue long. I would have set my stop down here at 896.5, which is obviously a lot less than 3,000. So this may have been my first trade. And then as I got multiple opportunities along the way, which, there's another one here, opportunity here, because now it's trending. So I would have taken this buy trade here. So I take multiple positions within a trend on the pair. And so as it gives me multiple opportunities, obviously I'm getting into different entries, but that's how I'll stack a trade up to where, although I'm taking maybe 2.5% risk, I have about 7 to 8% upside for about maybe 4 or 5% risk, because a lot of times you get more than 1-to-1 risk reward. And so I take multiple positions looking at the exact same setup. And so I don't need to trade every day. I don't need to have the market perform every day in the way that I want it to. I just need to make sure that I'm available when the market is giving me what I want to load up and really kind of go progressively into that bet. So now I'm going to go to the monthly, because somebody asked me how it looks actually easier on the monthly because this is 1 month's worth of data.
Yeah.
So this is literally, the whole month of what's that? 18, that's January 1st, 2018. So you can see how far back in time we went just because we went to the monthly. We're over here and we got all this, the market's been trending up. This is the NASDAQ. I'm sorry, the S&P 500. And so it's trending up, from the left to right, the market is moving up. And so we look at the candlesticks the same way. Doesn't matter what time frame it is. It's not going to move very much because we're literally at the end. We're like at the edge. But let me mark this up and see what I would do under these circumstances. Delete these.
Mm-hmm.
I'm just going to do a quick analysis and we'll get back to it. So I'm going to look at my vector. First thing I'm going to do is I'm going to set my vector. So how I set my vector is, okay, I see price was down. Just y'all have to trust me on this just in the interest of time. The market is turned long here. It's a level one long here. And so I have a pivot point down here. So I have to have at least 2 pivot points in the trend direction for me to set my vector. So I have this anchor point here, and I try to find the furthest to the right of the pullback point before moving higher is the starting vector. And then you want to go to the very first inflection point that it created. Let me get out here because I can't see that it created. And then that gives you your kind of your line. And so you can see here on the NASDAQ, on the S&P, price is actually trending higher. And so what we're going to be doing if the market plays out, like I said, on the daily chart, what we're doing, we'll be actually playing the pullback off of this move higher, back down into this blue area right here. So you can trade against the trend, or you can wait also for the price to get back down here, which it normally will do. And then you can take a better entry down here long. So on the monthly, the market is actually pulling back off of an uptrend on the S&P. So I would expect maybe, like you say, a month or so of maybe negative movement. Then the market will shoot back up, and it should be net positive for the year. But it's basically the same thing on the monthly as it is on any other chart. You're just kind of looking at the general direction of the candlesticks. Did that make sense?
That was Tim Martin. And Tim, I'm going to be testing you on that offline. So if you better be taking notes next time no, he's probably laughing right now, but seriously, take notes or follow up with Kevin.
Super cool.
Kind of a follow on, then I'm going to turn it over. We had somebody ask about platform. Then we'll definitely get into more questions. So 200% in 2023, that's outstanding. Over the last 10 years, what would you say your average returns are per year?
I would say I've played with a lot of different things. I keep an aggressive and a conservative account, and I test different things out.
Hmm.
And so, but I would say going back, conservatively speaking, let's say over the last probably just look at the last 7 years since I've been teaching people.
Sure.
I would think that about I'll say about to be conservative about 75 to 85% a year. Like I would say that's
Really?
yeah,
Wow.
75 85% is very like that's probably conservative that I think.
Consistently making a profit, and that's a sizable profit.
Over the course of a 12 months. I
75.
have some months where I've had a 22% loss month, so you have to kind of have that long-term mindset and and
Yep.
truly don't get like don't I try to the way that I avoid I do two things. The way I avoid a lot of the emotion that people feel that's human. I mean, it's the natural emotion, when you're talking about winning
Hmm.
and losing. I put myself on a withdrawal schedule. And so normally no more than 90 days go by before I take a withdrawal out of my account. So I don't have it all on the line over the course of the year. You
Sure.
can't do that in survive in this game because there'll be seasons where you have losses. And so what you want to do is you give yourself enough time to build up enough, momentum. Take a portion of that out. I put myself on a 60-40 split just like anybody else. So I'll take 40% of my profits out and then I'll take the difference, the delta, and then I'll trade that on. So every 90 days, I'm giving myself a payout, hopefully, and generally, so that way
Hmm.
I'm not forcing myself to do things that I don't need to do. Because it's easy to force yourself into kind of forcing trades or seeing stuff that you don't see when you're living off of it. So that's the way you kind of eat. You give yourself 3 or 4 months to like let the market play out. You take money out again, so you get that you have to get that reward, for your effort. And
Hmm.
then, you go back into the trenches and you get that reward for your effort and you go back to the trenches. So, that's how I generally trade. That's how I tell my students is you at some point you have to realize your gains. And you need to do it on a periodic basis, no matter how big or how small they are, to first of all get into the habit of rewarding yourself for your energy and effort, but then also so that as your gains increase, you've got a pile of money over here, and some people it's not an issue, but normally what you want, the ideal situation is you're trading to get to where you can fund yourself for several months off your activity, and then you give yourself the peace of mind to not have to win every day. And that's what I found works best for me. So, but I think even in the context of that, we're probably at 75 to 85% handily a year.
That's that's outstanding. What I'm hearing within your teachings there is number one, don't be greedy, right? Take some losses, but don't think it's going to go to the moon because it
Right.
could turn around, you could lose money. So you don't want to be greedy, remain humble, and yeah, keep a disciplined mindset. You can tell here we're probably just scratching the surface on this webinar, but I'm sure leading into your teachings, which we'll talk about in a second, what you can offer people if they want to learn more. But yeah, discipline and mindset ongoing. Like you look the other way for a second, and things can go south on you real quick. Real
Absolutely.
quick, to those who don't already use tickers, so setting expectations using Tykr for value investing, we do try to aim between that 15 and 50% mark. I know Warren Buffett, Charlie Munger, even Phil Town, they're big on that as well. You should be getting over 15% value investing. I'm actually closer to that 50% because I just buying really strong stocks, especially when they go down just a little bit.
I love that.
It's the discipline there, but well, in your case, you're beating that. You're spending more time, but with
Right.
trading that
Yeah.
75, 80, 85% consistently over the last, like you said, 7 years, it's really good. That's really good. And
Yeah. Yeah.
200% and
But
yeah,
I'll take 50 though. Hey, brother, I promise you. Hey, if my bad year is 50%, I ain't. And so let me piggyback on that real quick because
sure.
I think one of the value that I really find in kind of the unique part of my journey is I started off as a financial advisor, and so
Yeah,
I started off being that guy, which is part of the reason I left because I really there's a lot of things I just did not love about being in that
sure.
industry as a person. But you're trying to get people okay with the idea that 8 to 10% a year is okay. So
Mhm.
like they're basically saying that, hey, you shouldn't expect to earn, you should expect not to get 90% of your money back. Oh, yeah, I mean, there's a crude way of putting it, but like they want you okay with that and they want you to do that for
Yeah.
40 years. And then when people, when Buffett and those guys talk about the double digit returns, 15+%, people really are saying, how do we do that? You know, where do you do? Because nobody is
Yeah.
really, I think up until relatively recently, like with yourself, and groups like yours who really care about people, very few people are positioning people to know how to do that. And so that's actually a fair statement that plays into the hands of the financial advisors, because if you don't have the wherewithal to do it, you definitely need a mentor or somebody to hold your hand,
Mhm.
which they choose to do, but you do it at a much greater cost because you're paying them for their service, which it's okay to pay people for the value they provide, but the returns that you're getting for not being active in your own financial freedom is the cost of a significant amount of
Yeah.
money. I mean, you're literally what, 1/5, that's 20%. So you're giving up 80%. And I'm just basing that off of your 50% return and a
Yep.
10% expectation. You're giving up 80% of your gains just by being lazy or being
Right.
uninformed, you know? And so that's the truth. Like, you got to go from believing that it works to knowing it works. And the only way to do that is to do it. And you do that by plugging into the right mentorship, like Sean's, the right
Mhm.
methodology and approach, like Tykr. And then you have to use the right mindset, which is, I'm not going to get rich tomorrow. And where else on earth
Right.
am I going to get rich tomorrow outside of the lottery? And we know how that turns out. And so get your mind right. Like I tell people, everybody wants wealth. Everybody wants in what wealth represents, right? Freedom of time and movement and all those things. But people want that, but very few people have ever positioned themselves mentally to be able to even handle that, right? And so, like, you know, the person that you are out of college with no money, you know, proverbially speaking, is not the same person that you are at 40 with means and resources and wisdom. It shouldn't be. And so, why would you want to be in a 20-year-old mindset coming into a 40-year-old's results? Because you're gonna get the 20-year-old results because nobody wants to put that time in while they're growing their wealth. Nobody's putting in the time to get their mind around what's really occurring and what it really means to why I only trade 2 to 3 hours a day on the high end, because I know that this is not the job that you sit at for 8 hours or do
Right.
overtime at and do more and make more money. Like, this is the job that the less you do, generally you're going to make more money. And that's
Yes.
a mindset shift that you have to go through. You know, if I go through with the Georgia Pacific or the Merrill Lynch, you know, mindset where I'm going into the office at 7 a.m. and leaving at 10 p.m., I probably would go broke because it doesn't work in
Mhm.
this vehicle. So you have to get your mind around the concept of actually obtaining and preserving the wealth that you're trying to create. And so, anyway, I just want to take that. I think it's an important distinction that people need to really realize, that it's not just about the money, it's about who you're becoming as you grow the money.
Yeah. Right on. And revert back there to a comment. A lot of financial advisors, and we kind of teach this in our onboarding and training, some of the videos I talk about too, and you may agree with this, financial advisors and wealth managers, their job isn't to build your wealth, it's to protect it. And a big
Sure.
part of that is you can't be actively buying stocks for each of your customers when you have, because to make a living at that game, you got to have 40, 50, 60, 100, maybe 200 customers.
Right.
And I have known people that try to do individual trades for their customers and they're working 16, 17 hours a day. It's so time consuming. And I know there are software platforms that you can like buy 10 shares of Apple to all accounts, but if customers have different amounts of capital in their accounts and you run into issues, it's too noisy. So they just put you into ETFs, index funds, and mutual funds, which get you that 6 to 8%, maybe 10, but
Right.
set expectations. You can go that route, but that's why you're getting those returns. But like you trading, you're empowering people to do this on their own. A little more risk, but you can make some big returns. A little less risk, I would say. Value investing with Tykr.
Absolutely.
Aim for that 15 to 50%. You can definitely beat the market, but it's just you. You're just managing your account, not 50 other accounts, which is that's
Yeah,
crazy.
and so yeah, well, two things real quick. The first thing, I wonder how much that advisor is making. You know, because if you're placing trades for people, this ain't Wall Street back in like 1980. You know what I'm saying? Like the
Yeah,
movie.
yeah.
Yeah, that's not where the money's at. Like the money's in managed money. So they, like, the firms don't even want you trading for people like that. They want you managing it and putting it into these safe spaces. And so how you create that trifecta, because I do want to be clear that I'm not against it. Like, some of my best friends are financial advisors,
Hmm.
and they're very
Well, same
successful.
here. Yeah.
Right, you know what I'm saying? So I'm not poo-pooing on it. Even though I've had some really great intellectual conversations about where they fit in the world now,
Yeah.
but I think there's always a trifecta that can be had. And so I want to urge everybody, you guys who are on the webinar and listening, to try to always, like, emerge your mind to from a bipolar or a binary thought to more of a multiplicity of thoughts and a multidimensional thought, right? Like the multiverse, right? And so how do you marry having an advisor, having a wealth building coach like Sean, and then a trading coach like Kevin? What you do is you establish your goals first, get clear on what you want, realize what resources do you have to get there, and then do it in steps. And so a portion of that is preservation, right? The Maslow's hierarchy of need. Let's preserve and protect. So insurance and an advisor maybe that get you on a game plan. At least you're systematically investing and saving, and you're building that base. And then once you get off of that safety, that food, clothing, shelter type, safety net, the next step is you want to start building up the part of the pyramid that says, I want to be more actively involved in my wealth building. I want to have some liquidity. And so you're dealing with Tykr, and you're kind of building that piece up. And then at a certain point, you may have actually earned enough to peel off a portion, or maybe you saved enough along the way to where you say, hey, I want to just that top of the pyramid, that self-actualization piece. Everybody likes a little bit of excitement. I'll take a portion of my resources, and I'll get with Kevin and learn how to trade some of my resources. And that's now you have kind of a blended approach that doesn't hurt you, because you have some sustainable foundation. So no matter what happens over here, it actually helps you because you're not relying on trading to create your income. And so you have to really think about blending the resources that you have as opposed to shunning the resources, because no thing in and of itself will help everybody get where they want to go in most cases. And so I encourage you to really reframe your mindset. If you're thinking binary, kind of open up to a multidimensional approach. And I think that'll serve you a little bit better.
Right on. I'm going to start turning this over to the audience here. Some of the questions. There was somebody who asked, using pilot trading, they prefer the clear dials rather than the candle charts. What do you think?
With pilot trading, I'm not sure if I'm familiar with how that looks.
Okay.
Can you enlighten me a little bit?
We'd probably have to get into the software a little bit, which you and I don't have access to.
Okay.
Probably a lead question to that was, do you use pilot trading, or have you? Sounds like you haven't, but
That's a no.
yeah.
Definitely.
Here's one. This just popped in my head. You use IG. That's a charting tool. Is that also a broker where you buy and sell shares, or do you have to go to another software to buy and sell?
No, that is the broker. So IG is actually the broker, and then they just have the MetaTrader 4,
Got
MetaTrader
it.
5 form. Yeah. And so I use them to chart. I use trading. They're moving now to where a lot of brokers to where actually you can chart in trading view and execute, and it goes over to the broker that you're with, if you connected.
Sure.
So but yeah, IG is the broker, and then every broker provides access to either they have a proprietary platform, which they make more money from, which is totally fine, because there's generally more technology there. And then you have the standard platform that they offer, which is the MetaTrader platforms. And so I use whatever broker I go to, I use the MetaTrader platform because, first of all, that's where I started, and it's simple and easy, and I don't think I really need a lot outside of TradingView.
Right on. And for example, like I use TD Ameritrade, which is owned by Schwab, and it
Right.
has the tools Thinkorswim.
Mm-hmm.
And Thinkorswim is a pretty decent charting tool. That's where I'll make my trades. I can do them in TD or Schwab, but I can also just do them in the Thinkorswim. But yeah, I'm familiar with like TradingView is really hot. But otherwise, I haven't touched a whole lot of trading because I do not trade.
Right on. I got you.
But totally respect it. But
yeah. So to your point, to clarify that, where TD Ameritrade has Thinkorswim, which I'm a Schwab customer too. So like I still deal with these people. It's not like I'm just out here in DeFi land. So
sure.
but so they have the Thinkorswim platform, which is a very robust platform for trading. But I think they have a Forex component now. So you can use the Thinkorswim platform, and they normally give you better pricing over there because they control that technology. But they will also generally give you access to the MetaTrader platform as well. And so that's what the broker like IG does. They have their own stuff, and then they have the stuff that's kind of like the commodity. And so I just
Sure.
like using the commodity because that's what I've been using, and I don't want to learn a new system just yet.
Stick to what you're good at, right? You pick a tool and run.
There you
All
go.
right, audience, what other questions do you have here? Go ahead, drop them in either the chat or there's the Q&A pop up. Taking a closer look here. Real quick, while we're kind of waiting for any questions to come in, when you were showing the chart earlier, you were kind of saying that, hey, January, as of the recording of this video, it's like early January 2024, we
Right.
could see a pullback in the market, and some people can be afraid with comments like that. Whereas my mindset, I've kind of trained, gosh, this was probably 7, 8 years ago. I was like the aha moment, like, oh, I want that. Like I want more of that because my companies, in most cases, the companies I invest in, there's nothing that changes. Like fundamentally, like the business, services, products, it's not changing. Like, for example, I invest in Apple,
Right.
it's not changing its business model. So the market's going to pull back. What that tells me, if it's still a strong company, guess what? You want to buy more.
It's
So
on sale.
that's
Right.
yeah,
Exactly.
it's on sale. You want to buy more. So
Right.
that's my strategy. So when you said that, I'm like, okay, all right, I see you.
Yeah, I mean, and what you, I think what you just kind of separate yourself from what the emotion of that, like nobody likes
Yeah,
anything to go down, right? That they own or that they're looking at owning because now you're like, okay, well, if it's going down, is it still good? To your point.
right.
But once you see it for what it is, then that goes away and you like you say now this that's what where people are selling is normally where you want to be buying, right? I mean in most cases because
That's
the
it.
crowd is generally wrong, so that's what the pullbacks are. I was going to ask you, Sean, real quick, if I could ask something of you. If you have a chart on your side that you want to share, like the Apple chart, I can analyze it and kind of give you that short, since I wasn't able to do it on my side. I wasn't expecting that to happen when changing the brokers. If you want to, you can pull it up and I can analyze it from my side and show you what I think about any stock you want me to look at real quick.
I can show you. We'll jump into Tykr here. Hold on
Okay.
here. Our charts, like we're not focused on trading, so it's just very basic. Let's just take a look at Apple though.
Yeah, that's
Can you
cool.
see my screen?
Yes, sir.
All right, let's take a look here. This is what we have in our charts. There's not
Right.
there's not a lot of technical tools within.
Let's go to the 1 month or the 1 month though. I think the 1 month we can probably do some damage. Now,
Okay,
is it only a line chart or is there any other variation? Is that it?
this is it. Yep.
Okay. Okay, gotcha. All right. So yeah, I'm not gonna be able to tell from here because I don't know. I
Not
don't
not for
because
trading.
yeah, because what you want is detail, right? And so
Yeah.
like you need some granular details. And so apologies. Like just go to Yahoo Charts. If you want to pull up Yahoo Charts, they
Oh, yeah,
know
yeah. Yeah.
do something like that.
Which
Yeah.
is powered by Trading View, correct?
I think so. I believe
Yeah.
so.
We
Big
on our
part.
roadmap, we are looking like we've looked into TradingView charts. So the
Mhm.
audience out there, we may be adding that. It's not a top priority based on a request from the audience, but to add their charts. So yeah, like I like going here to Yahoo Finance. You can click full screen. Join beta. Try later. New
Mhm.
experience. Best charts yet. Oh, that's new. All right. Yeah. So this is all
Okay. All right.
Trading
So right
View.
there where it says line, if you wouldn't mind, change that to candlestick for me.
Okay.
Candle. And all right. So let's just do the daily because I want to keep it kind of higher time frame. So the date range, click 1D.
Right here.
Yes, sir.
There we go.
All
Okay.
right, cool. And if you wouldn't mind, move the screen from your left to your right a little bit so I can see. All right, there we go. All right, not too much. I still need to see the leading edge. Okay, so what I see here um, is that price has dipped significantly at some point, and then it's back up here, and it's actually technically it's just turned around. It's in an uptrend as I'm looking at it on the far right with the 18295.
Yep.
So it's looked like it's definitely in an uptrend and barring maybe a small pullback over a day or so, because I would want maybe some type of small confirmation, I would still be long on Apple, like definitely long
Hmm.
and see it going up. If you wouldn't mind, do one favor for me, click the 1 month chart, and that'll
Yep.
kind of let me see what it's looking like, and then let's zoom out so we can kind of get some clarity. All right, and then slide it over to your left a little, please. There you go. Okay, so you see, zoom in a little bit, just a smidge, so I can see the candlesticks.
Sure.
Okay,
How's that?
perfect, perfect. All right, so as I'm looking at this, you see it trended down, and it created so the price cycle structure. So you had this move up on your left. You see in the middle of the screen, it was marching right along. Yeah, and then it
Hmm.
and then it did the little Price is Right thing, the little yodeler. It fell off the cliff. Boom, yodel,
Yep.
yodel, yeah, right there. So so
Yep.
now so at that point, that's the trend and validation. Go back, yeah, go back a little, yeah, right there where the big candlestick is, the second one. There you go. So
This
that's
one
the
here.
trend validation right there. And then the next move lower is the extension low. And it does come back up into consolidation, but you can see price extended low 2 more times after that. And then what did it do? It turned right around and it looks just like the S&P chart, right? I mean, on the right where those green candlesticks are, let's
True.
go all the way over to where November starts.
Right here.
Right there. Yeah, so those green candles there, if you scroll, you go up about 7 candles, 3, 6, 7, maybe 8 candles
Okay.
right there. It looks almost identical to what we just saw in the S&P because it's the same structure. And so we have the downside part of the structure. So I would have bought, and then now price is going up and it's setting another price cycle structure within that structure. So it's still working itself out. So there probably can be some undulations in price, but I see prices in the middle of consolidation right now for Apple. So it definitely needs to give us a confirmation long because on the monthly it's showing short. But what I expect is price to pull back and go back up into this little consolidation. I see right where the Yahoo Finance is, that little
Hmm.
set of information, all that stuff. That's like consolidation where the Yahoo is, and so
It's kind
so
of
I'm
flat.
expecting price to come back up
Yeah.
into consolidation. So that's where we get the bullish behavior on the daily. We're expecting it to go up, and then it may chop for a while because it's got to make it through that consolidation and break out on the 200 side of everything. And so I definitely will be a buyer of it right here. Now, it's not giving me a trade right now, but
Hmm.
I will be buying it based on what I see and expecting it to break above 200 probably over the next, it probably won't be, it might be next year. It'll get back up and might be hanging in 190s, and it'll probably touch 200 and come back and then maybe go above 200 again next year. And that's I mean, I'm
Sure.
being so like super like as if I know, but I can see it getting above 200, but it's going to take some time. But I'm definitely bullish on Apple from what I see. It's taking a pullback, it's taking a breather, and it does need to give us. If you click back to the 1 day, please.
Sure.
What is giving us the indication that it's taking rest. So right here, it's actually technically long, and I would buy it now, expecting it to go up, but not going higher than 200 for a period of time. I think it's going to consolidate and hang in the 190 range for a while.
Interesting. Okay.
Yeah, so we'll see what
Hmm.
happens, man. We got it on tape, brother, right? So we don't know, but we'll
Right?
see.
Somebody can hold it to us
Hold
for
us to
sure.
it. Hey,
Yeah.
that's that.
Um,
So.
Tim asked another question here. Can we stick with value investing, ticker, inform buy and sell trades with technical trading knowledge? Good question. I'll answer that first, and then Kevin, you go ahead. So I have been talking to a few different organizations that are focused on teaching people how to trade.
Mhm.
Um, and their approach is to use ticker to work as the starting point because a lot of traders out there, they don't know, like, hey, how do I get like 5 or 10 really strong businesses for the long
Right.
term? Finding that is really tough because you could literally like go on Yahoo or Reddit or Twitter, and you can choose from, but are they really strong? You don't really know. So yeah, you can kind of like cut the wheat from the chaff, if you will, get a narrow list of strong companies with ticker. That's the starting point, and then apply your TA after is their methodology.
So when you say apply your T, are you saying, okay, buy these fundamentally and then trade options on them, or like
Well,
what do you?
no, like narrow down your research. Like find like let's say you're looking at 100 stocks,
Mhm.
and of those you find like the top 10, like in
Okay.
ticker, like the highest score, highest margin of safety, and then apply your TA teachings to
Okay.
those, let's say, 5 really strong stocks, and
Okay.
then you can do your buys and sells at that point.
Okay. So would you do me a favor and run me through like an example of what that would look like based on how you understand it? So I'm on.
Yeah, so I'll kind of speak on this organization's behalf. Is they've got thousands of traders in their, you could call it a curriculum or their teaching or their
Their
training.
universe. Yeah. Yeah.
Right, exactly. And these people are looking for really strong businesses, and they want to find businesses that they know for the long term they're probably not going to lose money.
Gotcha.
Because a lot of these people are going to be buying more than they are, or like they're going to be long more than short. In other words, they're not going to short stocks.
Right.
So they want to use ticker, and this is kind of an exciting opportunity. I hope it comes to be, but idea is their team can use Tykr on going to find those strong stocks, and then they'll trade against that. But let's say they decide like, hey, I don't really know my exit point. I can hold it for the long term. I'm probably going to make money. So it
Gotcha.
reduces their risk of losing
Gotcha.
money over the long term.
Gotcha. I think that's a great idea. I think that's an excellent idea. I
Yeah.
mean, I completely get that because you've really done a great job of helping people sort through the madness. That was one of my challenges, coincidentally. I know we got maybe have some questions, but when I started
Mhm.
learning how to trade, and you go back to the podcast to listen about that, I was reading a book, and I'm trying. And then I remember when I was in the army, there was a guy who was he was a trader. He had the Investors
Mhm.
Business Daily. He laid it out, and you had to be really intimately kind of connected to this stuff. It wasn't like a computer, and he would pick stocks, and I remember asking him, I'm like, damn, like how do you pick? Like how do you know what to pick? Now he had he had numbers and he had metrics, and so he's looking at
Sure.
PEs and all that stuff. But I'm like, this is like there's a whole world of stocks out here that you could be buying, and how do you know if you're missing out? And so what I love about technology and fast forwarding to where you are, Sean, is
Mhm.
that you're really curating a refined list of ideas that people can
That's it.
really sort through the masses.
Yeah.
Yeah. And I think with that, your probabilities of being successful using the technical entries are like massive. Like I
Kind
completely see that. Yeah.
Yeah, that's what they're saying too. And I guess I kind of saw that on the level, but I didn't see it as like a business opportunity for Tykr. But I was like, huh, we can actually help the trading community,
Yeah.
reduce the risks of losing money and making, sure you can make some money in the short term, but if you decide to not do a selling moment,
Right.
let it ride, and over time it's probably going to make money. So,
I think the
uh,
biggest part, the biggest benefit, potential benefit of having it set up that way is that um you want people in it for the long haul anyway. But
right.
how about if I could get it for the long haul, but have supreme confidence from a technical standpoint that I'm making the right choice? Because that's really what you're doing. You're kind of mentally stamping that, like we said, safely getting started is I at least know that I have some good stocks. I've got some good information on the trades, and I shouldn't even like based on whatever they're telling you. Hey, I might not even have to look at this for a couple of years. If I like
Mhm.
legitimately, I could literally go somewhere to Tibet, for 2 years and not have to worry
Just
about
punch
it
out.
and,
Yeah.
and come back and I'd be okay. And that
Yeah.
that level of confidence, because that's what we're talking about, where you're
Yep.
trading, investing, and all that stuff. It's all about the levels of confidence that you can create, in a circumstance, in a concrete manner, not in a like a spooky spiritual manner, but like what kind of concrete evidence can I do to continue to solidify my case that I'm making the right choice? And that's what all the things
Mhm.
that you're talking about, all of those things are kind of conspiring to create that for your members.
Right, right on. Tim, thanks for the positive feedback there on using Tykr. Yeah. Another question here, Mukesh asked, what suggested platforms do you use? You use IG? Anything else you recommend out there?
As far as brokers, I try to find the brokers that's regulated and can give me at least 1 to 100 leverage. But you can't get 1 to 100 leverage in the US. And so I
What
stick with
real quick here, what does that mean?
okay,
Just
sorry.
for the audience here.
Right on. So leverage is what makes the Forex market kind of attractive. And so just as a quick example, if a dollar in the Forex market can have the buying power of say $100, right? So that's 1 to 100, just kind of simply put. And
Sure.
so if you have $100 worth of buying power where a dollar has to go up by 100% to become $2, a dollar with 100%, 1 to 100 leverage could theoretically only have to go up by 1% to get that same dollar. And so that's leverage. It's like doing more with less or whatever. So the reason that the Forex market has leverage in it at all is because if you think about it from a fundamental standpoint, like I say, some of this is common sense. If the price of the dollar, like Bitcoin, is fluctuating wildly, right? It's a great
Mhm.
speculative tool. It's not a tool to buy milk. And so if the dollar has to be a safe haven currency, it can't fluctuate by 5 to 10% a day and allow us to have an economy that's functional. And so what they do is they take the 5 decimal points to the right of the penny and they trade on these what are called pips. So like 1/1000th of a percentage point, they leverage that up just like banks do with the money that they get. They leverage it up and trade off a larger number, and that allows you to actually make to have a $6 trillion a day industry when the dollar doesn't fluctuate very much. And so that's why we
Mhm.
have leverage. And so what I try to find is just a firm that has 1 to 100 leverage, because it gives you more flexibility in the trading. But as I was telling a guy who joined my challenge this morning, one of my actually longtime friends from Alabama, he said he signed up for the challenge we got coming up in a couple weeks,
Mhm.
and he was asking what broker, and he's traded before. I actually got him into trading like over a decade ago. And so he was like, I like this broker, can I get 1 to 500 leverage? I'm like, well, I say you shoot with different weapons than I do. So like 1 to 500 is cool for you, but I don't need that much. And I can actually use 1 to 50 and still get the 75 to 85% a year. So for me, it really doesn't matter. But what I don't love about the US based is that you have what's called the FIFO rule. So the first in, first out it changed with Dodd-Frank to where offshore with a regulated firm. So I keep some money offshore and then I keep some in the US, because the world's getting actually crazier. So I see myself becoming that old dude now. Like, I was the dude who was like about taking risks and screw it and screw regulations. I want my freedom, and now like when you start getting resources and you start getting a little older, you're like, man, you know what? I kind of like somebody looking out for me a little bit, like it's
Mhm.
okay.
Mhm.
I mean, not too much, but I do want you looking out for me. So I pulled a lot of my resources back into US brokerages, because I just need the peace of mind. Um,
Sure.
but 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 to the point, so with the 1 to 50 leverage, the FIFO I don't like. The leverage is okay. So if you're out of the US, you can do last in, first out. So what that means is what I was saying, when I take multiple positions on a trade setup, if I see one that I want to maybe take profit on while another one is continuing to grow, I have to in the US, I have to close out the first trade before I can close out the second trade. When I'm not in the US, I can close out the second trade before the first. And that to me is very valuable, although I can trade the other way. So I just like the more about less than leverage. I like the flexibility of having, which trade I can close out at any given time. But given the choice, I'd rather just have to go with FIFO and keep my money.
Yeah.
So I use
Katie,
IGUS. Oanda is another firm I use.
okay.
Uh, and then I'm trying to find a foreign broker that I can trust so I can put some money over there. But I use two
Gotcha.
firms right now, Oanda and IG.
Gotcha. Okay. That'll be a good list. And of course, anybody you can reach out to Kevin offline if you have other questions. I know some people on the call may be, located in the States, maybe as we saw some are based out of the UK, London,
Right.
but they could be in other areas as well. And what I kind of teach to our audience, we've got a broker's page just on our marketing site, just free resources, kind of like everybody's favorite broker for investing. I know trading it, right?
Yes.
There may be different platforms, but
Sure.
you
Sure.
might have a list that's similar. Okay, with that in mind, I've got to kind of wrap it up here. I'm going to a podcast, but if you
You're a
can let
busy
people
guy.
know, trying to be busy here.
Right on. Right on.
Where's the best place people can reach out to you?
Thank you for that. First of all, before I answer that, Sean, again, I give my total gratitude for our relationship. I love, I
Sure.
give gratitude for how you're approaching the world and how you're taking something that you're passionate about and really creating value through the purpose of serving others. And I'm
Sure.
always grateful to be affiliated with people of such high and high
Thank you.
character and integrity. And I would say you can find me on fmtrades.com. FM like a radio station, trades with
Mhm.
an s.com. That's where you learn about what we got going on, where we do DIY trading for do-it-yourselfers. I do a private one-to-one mentorship. So I don't take on large groups anymore. I take on a select number of people. And what I found is they have faster success and more success with me working with like 10 to 20 individuals on an individual basis, but only taking 10 to 20 people at a time, so I can give them that energy and time that they need to get going where they want to go, as opposed to a class of 100. And so we have the DIY side, and then we have what's called the DFY, or done for you side, to where we will trade for you if you're not ready to trade for yourself. But fmtrades.com is probably the easiest way to find us.
Nice. Do you have any kind of coupon codes or special offers at the moment?
Yeah, so we've got a challenge coming up, and I'm going to put it in the chat because it's a different link. I'm going to go to the website, so fmtrades.com, and then I'm going to put the SD, yeah, I think that's it. Yeah. And then I'm going to put the code. There's a code that gives you 50% off. I think it's called Act Fast. It's good until I think the 8th of January. And so let me explain what the challenge is. The challenge is where a person who may not know if they're, forgive me for looking down, I'm trying to find this coupon code. Um,
Sure.
Act Fast. Okay. So Act Fast is the coupon code. I'm sorry, that's not Act Fast. That's AC Phasey. All right, boom. And so what I did was I decided to give people exposure to what trading can produce for you by allowing people to piggyback on my trades. They open up their own brokerage account, they fund it with whatever amount they want, and then they pay the price of admission of $1,000 to take part in my challenge for 60 days. And so basically what they're doing is becoming a member for 60 days at a fraction of what my normal entry fee is, and they get to keep 100% of the money that I make for them over 2 months. And what I found is I started this in November of last year, and I didn't bring anybody in. I just ran the numbers. A lot of people are interested in that approach because they don't know if they want to commit fully. My prices aren't low, so I understand that. And so you can join the challenge here, and then if you sign up by the 8th, which will start on the 15th of January, the next challenge, but if you sign up by the 8th, you get 50% off of the enrollment. So instead of paying $1,000 to become a member of the challenge, you get in for $500. So thanks for reminding me.
Cool. All right. I think we're good. If
Yeah,
anybody else has any other questions, you can reach out to Kevin directly, fmtrades.com, or you can certainly reach out to me and I can get you guys connected. But thank you, Kevin, for jumping on the call. This is awesome. Diving into TA a little bit further. And thank you to the audience for jumping on as well. Good questions. Good to have you. Good to see you. Some familiar names again. And I'm sure we'll see you guys on another webinar here in the future. We'll see you.
thank you. Enjoy the day.
All right.